Welcome back. We are speaking with Phil Davis, and very soon we will get to his trade of the year. But first, Phil, you filtered through literally thousands of stocks looking for certain characteristics, the ones we talked about, and you have a list of names you want to share with us. So let's get down to counting them down. We have 4, 3, 2, and then we'll get to the final trade of the year. Number 4, Energy Transfer, ET.
Mm-hmm.
Tell me about it.
Well, we love Energy Transfer because they're a pipeline company. They are the toll road for natural gas and liquefied natural gas and such. They are aggressively paying down their debt, which is nice. Their export volume continues to grow every time they add a liquefied natural gas terminal in the United States. What are they doing? They're exporting the gas. If they're exporting the gas, then it has to go through pipelines like Energy Transfer, hence the name Energy Transfer. and it's a fantastic growth area. And also, as the price of natural gas goes up, which it will do because we are the cheapest natural gas in the world, and so if we're exporting our natural gas to places where it's more expensive, then the price of natural gas will equalize closer to the level of the rest of the world where it's much more money than in the U.S. Therefore, higher fees for Energy Transfer as well. So growth. Hard to imagine why it would stop.
Yeah, and this is like the picks and shovels thing. It's like your toll road, same thing. Just get in there at that level.
It's a part of the energy part of the picks and shovels infrastructure. Yeah, for sure.
Yeah. Okay, tell me about the trade. Tell me about the structure and what you're doing with it.
It's a pretty simple structure. We're doing a bull call spread as a long position, and it's an unbalanced bull call spread. So we're buying 50 of the 2028 $13 calls. We're selling 10 less of the 2028 $17 calls. So it's a $4 spread. And if you multiply that by 50, it's $20,000 of a spread. We're selling some puts, the $17 puts. We certainly don't mind owning them down at that price. And we're also selling the calls of June, so 6-month out calls, and we're selling those for $1,800. So the net of the spread is $3,500. We're going to own this for 2 years. We're going to have 3 more chances to sell short calls, and I'm sorry, 16, not 18. At $1,600, it's almost 50% that we're collecting every 6 months against our outlay. Plus, there is a $16,500 upside if we hit our target at $17. And by the way, it's at $16.50 now.
And the risk. And the risk on this one
is not ambitious.
Yeah, not ambitious at all. It's and the risk on this one is what?
The risk on this one is when you sell the puts, and you don't have to sell the puts. All the puts do is reduce your net by $6,500. So that's a nice thing. But you are promising to buy 2,000 shares of Energy Transfer at $17, which is $34,000.
Yeah.
So that's your risk, is owning Energy Transfer. By the way, a lot of people look at it the wrong way because they say, "Oh, I'm promising to buy 2,000 shares for 17, so I'm risking $34,000." You're only risking $34,000 if they go bankrupt.
Right.
And you know, if we're not completely wrong about this company, it's not going bankrupt. Maybe it'll go to $10 if some catastrophe happens, and then you're going to lose 20 times 7, which would be $14,000. But you're not going to lose $34,000. That's incredibly unlikely.
Yeah, and I guess the thing just to get the liquidity risk, just they need to have that money to fulfill on that. That's the risk, not the value.
You should never ever sell short puts on a stock you aren't willing to own for years to come.
Right.
You've got to want the stock before you sell a put. But like I said, all you're doing when you sell these puts is getting $6,500. If you don't sell the puts, then the spread costs you $10,000 to make $20,000 plus the short puts that you sell. Maybe you'll make $22,000.
Amazing.
So,
all right, let's get to this next one because we got to get through 2 more. So number 3, we went from 4 to 3, Micron, and notable that it's Micron and not NVIDIA.
Oh, yeah. No, NVIDIA it's kind of got a runaway valuation, whereas Micron is really undervalued. It's more like 10 times earnings for some silly reason. They are the high, with every single NVIDIA chip, you also need Micron chips. You need the memory, what they call high bandwidth memory, HBM. Um, Micron is huge in this market now. They're getting bigger. It's just a growth market that they've broken into, and they are there's becoming a huge supplier on the level of like Samsung and things like that. And the earnings are going to keep growing. And it's not just AI. It's also all the screens and the robots and the cars and blah blah blah. Everything needs these chips, these memory chips. Everything's going to need to have this in it. So huge growth opportunity in a space that people are, for whatever reason, ignoring Micron.
I wish I could get a memory chip. But anyway, let's get to the trade.
Yeah, put it right there.
What's the trade, Phil?
In this trade, now here, we're not using, because it's such an expensive stock, because it's $200, we don't want to sell puts because it takes up a huge amount of margin. So instead, we're setting up this what we call a ratio spread. We're buying 5 of the 2028 $200 calls. We're selling 3 of the 2027 250 calls, and we're selling 2 of the March 250 calls. Now, what we're playing on here is what they call theta decay. In other words, a time decay. Our very long 200 calls have 2 years before they expire. The March calls have months before they expire. The 2027 calls have only a year before they expire. So the advantage is our long calls decay at a much slower rate. And as the other ones decay, we just either sell more, or if the stock keeps going up, we roll them over to a higher strike. And we can turn this very easily. It's taking me a while to explain it, but we can turn this into a $200, $400 spread, not a $200, $250 spread, because we can keep rolling and rolling and rolling over time. And that means the upside potential for this spread is roughly $75,000. So basically 300% upside potential on this very simple spread with no margin. So your only risk is the 27,600 that you're laying out.
Yeah.
Versus a potential $75,000 upside.
And can I ask, sorry, just because we're tight against the clock here, and the risk is here just the outlay, right?
The risk is the cash you put in. Correct. There's no puts. There's no puts in this situation at all.
All right, let's get to the last one before the trade of the year. I've only got about 90 seconds here, Phil. So tell me about
90 seconds.
I know. Tell me about PPL.
Well, PPL is another power play, but it's this is a power plant play. All these data centers need power plants. We have to build dozens of power plants in the U.S. PPL already has contracts. The government is already subsidizing it. The money is flying in their direction. It's a no-brainer. It's a utility, and they just build another plant, they turn it on, and it gets used. Easiest thing in the world. And the real thing about the AI centers is they use a lot of power at night when people are home and using and people at home and asking questions on the internet. And the thing about that is that it's the better time for them because PPL has more power available at night. So it just makes better, fuller utilization of the plants that they already have.
Let's bring up the trade here, and you take us through it.
Okay, a slight imbalance in the long end. I'm just going to say what you guys can see it, so I'm not going to still talk about every piece. We've got the in this case, we are selling those 35 puts in 2028. We're also selling the 33 puts in April, but they're balanced against the 35 calls. So the amounts offset, and if you have a portfolio margin account, you barely get scratched by it. Obviously, it's a big downside risk on earning 2,500 shares of PPL for $35. That's quite substantial. But the upside potential on this thing is net 600 cash, $24,000 upside. That's 4,000% return on your cash which is why we don't mind holding all that margin, because the return on cash is significant. And again, it's a utility company. We really don't feel that the risk is anything near $35. You know, if it drops 20%, we'd be shocked.
All right. Okay, stay with us, everybody. When we come back, you're going to get the trade of the year for 2026. You're watching Money Talk. We'll be right back.